Welcome back to what I call Wading Through Economic Filth, or Wealth of Nation, where I seek to explain things going on in the Canadian and global economies. I'm Greg Quinn. I spent the last 2 decades as a business reporter in Ottawa. I'm trying to merge my knowledge of economics and journalism into this evolving world of media tech at a time of rising disinformation. I also wrote a book, which you could see over my shoulder, about the work of Canada's central bank over the last few decades. Inflation and affordability have dominated politics and society in the last few years. The Bank of Canada is a big part of the picture when it comes to those topics, and it's not always well understood, so I hope this is helpful. This video is answering one of the number one questions I've heard at Bank of Canada speeches and elsewhere when people find out what I do. It's the US just cut or raise interest rates. Why can't we just do the same? In other words, why doesn't the Bank of Canada just follow what the US does? Intuitively, it makes sense because obviously, until very recently, we sold about 3/4 of our exports to the US. We're clearly major economic partners, and over time, our economic cycles have been influenced by what goes on in the US. I would say we are similar to the US in some ways, but there are important differences. Exports remain a major part of our economy, and in a way that is not the case in the US. And the prices of commodities are tied to particular global markets and can be more volatile. So there are times when our economy can be booming because of a boom in prices for gold or oil or wheat, and the US will not feel the same thing. So our economic momentum can be in a different place. The other element is economists refer to the US as a relatively closed economy. Most of its economic momentum comes from consumer spending and other factors within its own borders. Trade is a much smaller part of the American economy. We are what's called a smaller, open economy. We're much more influenced by global trade, not just in commodities, but in other ways. So our economic momentum is focused much more on things that may be happening in the US, but also are happening in other parts of the world. And again, that can lead to periods of different economic needs and drivers. So in some ways, just slavishly following US monetary policy set by the Federal Reserve could lead to a more volatile Canadian economy. What you don't want is interest rates or that are too loose or too tight for our own conditions, but rather focus on what we think might happen in the US. A cute way of looking at this is I tend to think of it as, what do you do with your lawn in the summer? You might be asked by your partner, when are you going to cut the grass? The neighbor just cut their grass. Very few of us cut our grass on the same day as our neighbor. That could be for different reasons. But when you drive down a lot of streets and neighborhoods, most of the time the lawns look maybe about the same. Caring for a lawn can depend on different things. Maybe I have different information about the weather than my neighbor. Maybe I know that I fertilized my lawn recently and it needs to set for a little while. There could be other things going on. Maybe I want to seed my grass. So there can be lots of different and legitimate reasons to do something very similar, even though the grass just a few feet away from you is getting a different haircut from the neighbor's lawnmower. Another issue that's related more broadly to this than just a day-to-day, month-to-month movement in interest rates is talk of replicating what's called the dual mandate of the Federal Reserve. Congress mandates the Fed to tackle what they call stable prices and maximum employment at the same time. The Bank of Canada has a single target: keep inflation at 2%. Recently, a few years ago, the government and the bank agreed on a framework that would allow it to try and seek higher employment, but only if the inflation target is being met. Over much of the last few years, inflation has been much too high for us to test how well that works. An argument I would make about this is because the US is the world's largest economy, it also has the reserve currency in the US dollar. I would argue it has a bit more flexibility to attempt to reach two targets with one instrument. I've spoken before about the problem economists see in that you really only have one tool, which is the policy interest rate to influence the economy. So inflation is much more closely influenced by interest rates than employment, which again can be tied to things like education or social attitudes. Interest rates have no control over that. So if you lean really hard on trying to boost employment, you can lose control of inflation and potentially employment as well. So it could be a risky proposition for any central bank to try and have a dual mandate. The other thing, of course, is Canadian economists remarked at when that extra language is added about employment that it seemed to water down the commitment to inflation, or at least the perceptions of inflation control. And again, this was at a time when inflation was sort of high. So economists have expressed some discomfort with going further and giving a permanent dual mandate here in Canada. This again is a bigger question that Canadians might want to be asking their leaders as this review takes place of the Bank of Canada's mandate this year. We tend to think of monetary policy as just that interest rate lever controlling the economy. You jack up interest rates, inflation comes down, but the economy slows, and vice versa. But what's been forgotten in recent years is we also have a Canadian dollar, which is influenced by interest rates. Officials have often called it an extra shock absorber for the Canadian economy. If our economy is relatively weak and we lower interest rates and the US doesn't, that can stimulate the domestic economy, but it can also weaken the Canadian dollar against the US dollar and other currencies. What that can do is boost our export sales and employment. So that can be very helpful in helping us get back to where we want to be. If we moved interest rates in lockstep with the Federal Reserve, we would lose that capacity to see the Canadian dollar as that extra shock absorber for the economy. But even if you believe that a great deal of our economic cycle is tied to the American economy, I would argue we could still perform better by following our own path on monetary policy. And that can be significant in a world where big economic gains are harder and harder to come by. The recent historical record shows me that in reality, the often asked question about following the US just doesn't hold water. Following the 9/11 terror attacks in the US, it was clear that Canada's economy was also going to need a lot of short-term stimulus, which the US was offering. But in the end, we offered stimulus, but we did not experience a recession, which the US did. This was a surprise to Canadian officials of the day. If we had continued to apply major stimulus or matched the US tenor of stimulus, we might have, in some ways, overheated our economy. Again, in 2008, when the US housing market and banking system crashed, we also implemented a lot of stimulus, and we did face a recession. But our banking system survived, and banks continued to lend. This was a very different experience than the US. As a side note, you could argue that the resilience of Canadian banks led to a bit of overconfidence, which sowed the seeds of our current stretched housing market. It encouraged banks and consumers to think that our housing system is super safe, it's been through the worst, so we will continue to grow the housing market ad nauseum. And you can see where we've ended up now. But to go back to this picture of 2008, the US deployed quantitative easing or massive bond buying in addition to slashing interest rates in another effort to boost the economy. I talked about quantitative easing a bit in my previous videos. I'll probably focus on it again in the future. But all to say, this was an entire extra element of monetary policy that the US deployed and Canada did not touch. Again, if we had gone as far as the US in 2008, it likely would have warped our economy. And again, it could have put even a further impetus to growing our housing market to the scale that we are uncomfortable with today. Looking at our most recent experience with the US, when President Trump imposed tariffs last year, the Bank of Canada cut interest rates faster than the Federal Reserve. The US economy was already growing a bit faster than ours, which gave the Fed more reason to leave interest rates in place. So if we had matched US policy last year and kept interest rates relatively high, we likely would have gone into a recession. Indeed, I believe our economy shrank uh, for one quarter and was very close to shrinking for a second one to mark what economists call a technical recession. In the end, it's fairly certain that we avoided a recession last year. That's a big deal. Now, this year in 2026, with President Trump looking to install acolytes who will slash U.S. interest rates, this is at a time when the U.S. faces some inflation pressure. We still face some inflation pressure. If we followed Fed policy too closely in these circumstances, it might again threaten our best path. The Bank of Canada has signaled that it's good to leave interest rates alone for a little while, and it believes inflation is going to stay on target. But which again tells you, if the Fed ended up slashing interest rates this year, and we just for some reason thought we were going to follow that, that could create some bad problems here. Indeed, there was a phase I was reminded of when I started as an economics journalist. An investor sent me a study that showed way back when the Bank of Canada for a phase followed Fed interest rate moves within a few days more than 90% of the time. This was something investors clearly noticed and, in some ways hurt the bank's credibility. If you don't believe that they do their own thinking, set their own policy, it really means investors have no reason to believe that the bank is going to do anything substantial on its own. I will say that central banks do learn from each other, however. Canada and the US are no exception. The Bank of Canada recently moved to publish minutes of its meetings, just like the Fed has done for a long time. This, to some people, brings fresh transparency to the bank's operations. The Federal Reserve also moved recently to systematically review its policy framework every so many years on a regular basis, just as the Bank of Canada has been doing for quite a while now. So that's a hopefully short look at this topic of the question of why don't we follow what the U.S. does. Before I close, rather than to tell you to read my book, I want to recommend a couple of books I found useful. One is Alan Greenspan, The Age of Turbulence. He was called the maestro, considered very ultimately successful for managing the U.S. economy, but he gives a lot of insights into how the Federal Reserve works when it's working well. If you want a more skeptical view, Secrets of the Temple by William Grider, subtitle, How the Federal Reserve Runs the Country. He took a more skeptical look at what the Fed was doing for the American public. Anyways, they're both excellent reads and can help you think about how the U.S. Fed works and what that might mean for us. Thanks very much for watching, and see you again soon.